everyone, and welcome to Mish's Market Minute Stock Charts TV segment. I am your host, Mish Schneider, and once again, I'd like to thank the Stock Charts team for having me on. So today we have another very busy agenda. I want to follow up on two major themes that I've been thinking a lot about in the last couple of weeks. One is sort of a follow-up on what I did on the Daily 5 on Monday, which is if we lived under a rock. And the other really goes back to the theme we did on April 16th, which was charting old school. Basically what we did is we looked at the 1970s and stagflation, but this time now we're going to really take a look at how we began in charting long before we had all the bells and whistles in modern day. We're going to do that through the economic modern family. I'm going to give you a lot of levels to be looking at for the next week as we are at incredibly interesting points on the chart. So if you want, have a pen and paper ready. And then we're going to go back to re-examine the stagflation or inflation factors and certain indicators, some of which actually flash that perhaps we're really onto something, particularly in the food area. So let's start right now with the modern family. These are the weekly charts, and you can see now I'm full on stock charts. So thank you to people who helped me figure out how to do all of this. This is the weekly chart of the Russell 2000 IWM small caps. And to remind you, this is the granddaddy of my economic modern family. The reason being is that it's a very good measure of the US economy, in that we have a lot of value stocks in here, a lot of manufacturing stocks in here, and all 2,000 of these small cap stocks do produce in the United States. So we could actually kind of call this a supply side. What I really liked about this chart is you can see that this is the 50-day moving average up here. Excuse me, this is actually not the 50-day, it's actually the 50-week moving average in the blue. And then we have the green, which is the 200-week moving average. So this is the famous crash that we had. We had gapped down on this week, went straight down for 2 weeks in a row. That brought up, now that we've come all the way back, this wedge. So essentially what we're looking at right now, and when I say old school, back in the days when I was on the Commodities Exchange, we had one little Quotron machine in the booths where the clerk stood. Otherwise, we got a magazine every week called Commodity Perspective, where literally it would come on Friday. So that meant Monday through Friday until you got your new edition. You had to put exactly what you see here by hand with a protractor, high, low, and close. And from there, that's where I started to see things like channels and wedges and trend lines. So I just wanted to tell you why it's old school. So you can see nothing else on the chart. No MACDs, no Ellie waves, no Fibonacci's, no nothing, just this, because it's very clean. So what we have right here is, by the way, some people, and there is debate on this, that you can either make a chart on a 2-point that it has to, a trend line that it has to be on, or 3 points. This is not perfect. I thought I drew it perfect, but just a little heads up here, I was never the kid who drew within the lines at school, so just it should be a little bit lower, but you get the idea because it actually connects to the low that we've had this past week. So essentially this is what we're looking at right here. 124 is your major support on a weekly basis. We can have a lot of noise here within a big range, but if it breaks down on a weekly basis under 124, I think the jury is out. We are going lower. On the flip side, we've tried to get to the top of the channel here, and again, this could be brought in a little bit, but this 136, 137 level is the top. Generally, what you want to do with that is if it breaks out, you may get a little bit of a chop, but if it does break out and it holds, then we can say that this thing is going higher, regardless of what's going on with the economic numbers. Forget about all that. That's where we're living under a rock. We want to forget about anything but pure price, and that's what I talked about on Monday. Now, what happened this week is we got close and we started to sell out, closing around here at 130, so we're smack dab in the middle. That makes for some difficult trading for one thing, and also, as we're in the middle of earnings season, also makes what you're seeing here is extremely choppy situation. So now we're going to move on to Granny Retail. Now, Granny Retail is the brick and mortar retail. This is where value came in. And if you'll also look, we don't have charts for this today, but I'll just mention that junk bonds actually outperformed the high grade bonds this week. And that's because the Fed has really been supporting the junk, the debt, taking the debt of pretty much everyone. And that's what we're seeing here with granny retail. So this is mainly brick and mortar, but you also have a component of Amazon in here. So even though you're seeing Macy's and Nordstrom's talking about bankruptcy, this actually made a nice move up. Now, the reason why this blue line is here is if you go back actually even further, but if we start at 2017, so we've got a 3-year horizontal line with the support that it had right around 37.50, 38. So when we broke that, the crash. Now we pierced it this week, but we're now trading underneath it, which means if it closes at the end of the week underneath this 37, you either have a very low risk short if you want to do that and risk to over 38.50, or you can wait till next week for some level of confirmation, and I would say probably a break under this weekly low would do it. Now let's move on to the next chart, which is IYT. Now, IYT is the transportation sector, and in transportation, where Grandpa is our supply, this is our demand. Now, again, this is a tricky area in terms of the economics because the demand obviously has gone way down, but on the other hand, people are getting things delivered. So this is why this is a really good gauge to see just how much consumption there is out there. And this channel that you're looking at is extremely interesting because this goes back to 2015 at a price that when it broke out and tested was really an area of support, as you can see, until this year at the crash. So once again, we traded above it briefly this week. We're now back below it. 152 is going to be the area that you're going to want to look at. If the weekly closes above it, that most likely means that this rally isn't over. On the flip side, if you want to use some level that's kind of pivotal and underneath this week's low, a break under 145 would make me more of a seller. Now this is IBB. This is my favorite of all the charts that I'm showing you because this is a perfect parallel channel. In other words, this line, the top line, blue line, and the bottom blue line is equal in terms of its distance, making it parallel. So if we look at the top here, this connects the highs that go back from 2015, which by the way was the year this actually peaked in price, connecting the highs from 2018 and then to the high that we just had in 2020. Now, that's another important signal right here. This level right here, again, IBB probably of all the sectors, I would say maybe semiconductors second to that, has the best chance of actually continuing the rally, obviously because of all of the necessities that it's trying to create with vaccine and preventative measures and treating symptoms, etc., of the COVID-19. But again, let's go back under our rock. Forget about all that. If this thing goes out over 129, especially on a weekly basis, chances are we could have a really big move, and I would say maybe even the possibility of seeing new highs in IBB. Conversely, we're not going to wait for this to get all the way through 94. However, same theory. If it doesn't break 129 and it closes this week out, let's say under 124, maybe now we have a low risk short to see if we can get some kind of correction. Maybe first place we've been looking is at around 110. Next one is KRE. Now, KRE has been the regional banks, and by the way, I didn't mention that IBB obviously is biotech, and it's the big brother, and it's a cyclical and non-cyclical, but this one here has been very closely tied to oil. But even when the oil was still crashing up until a couple of days ago, this actually started doing a little bit better. So we only have one line here. And again, this goes back to 2015. This was the high until it took it out, till it tested it again here in 2018 when we had that crash in December. And then boom, looked like it might have held. And then gap lower, there you go down. So again, this still has a gap, by the way. So that's a negative. When you still have a gap, it means that if the gap doesn't get filled, that means it's exhausted still. But yet it also looked like it was going to fill it, couldn't, reversed. So again, most conservatively, if you can get through 40 and get through 42, unbelievable good news for the market. But on the flip side, if it breaks 35, not so much. And then finally, I think we have for the family, this is semiconductors. Now, semiconductors, I have a few lines in here. So first of all, let's look at our 50-week and our 200-week. Now, the first thing, and again, here's where that debate is do you need 2 points on a trend line or 3? The person who trained me on the floor, who was amazing at it, said that you could have 2 points. So that's why you've got 2 points on this one. This goes back to the low of December and connects the low so far of December 2018, that is, and connects the low of this past move. So also what's really interesting is that trend line and the moving average, the 200-week, coincide. Now, we're far away from that, but just kind of store that in your brain. So right now, what we have here is based on this new low, a trend line is legitimate when you make a new low, a higher high, another low, another higher high, et cetera, et cetera. And that's where this wedge line comes in. Again, not perfectly drawn, but again, that's just me. It's close enough. And you can see we got to the top of it before the crash. We broke the bottom of it. This connected some good points here, this low and this low, and waffled around, and then boom, got down to this low right here. So now, as we're rallying, what we really need to see is for semiconductors to get through and close above 144, 145. Let's give it a little bit. These are areas, not precise numbers. And since we never got to it, basically what we can do is we can use the 50-week moving average right here at 124.50, or a break around 124.50, 124, and I'd say that's it for the rally in that as well. Okay, let's go on now to the second part of what I wanted to show you, which is the as I said to you before, the last segment that I did, which was on April 16th, 17th, was all about the 1970s and the idea that instead of looking at this period of time comparative to the depression we had in the 30s, I see it more closely tied in with what happened in the 1970s. And just to kind of remind you, a lot had to do with oil, which had made a historical low. We got right down to that low most recently. I think in the 70s, actually this low went a little bit lower, but we're above it now. So again, an area. And then of course we had the Yom Kippur War happen, and then we had the OPEC. Next thing you know, we went from a glut of oil to a shortage of oil. And that was a spark. We had a recession going on. And then what happened was after that, the rates, the Fed had lowered the rates. They did that also in the lower 70s. They did it again in the mid 70s. And then of course what started to happen, because of all different types of factors, geopolitical factors, Watergate, etc., then some environmental factors to the agriculturals and particularly the softs, stagflation hit, and by the end of the decade, we had gold, silver, sugar, and a lot of commodities going out of control, while the economy stayed in a recession really till about 1982. So what's looking like very similar right now, some of those things are setting up. If you're asking yourself what would spark the oil, at that point, it was a war. And, you know, nothing is out of the question or off the table at this point. So what happened this week to me, especially today, that is so interesting is what I told you guys was that I thought it would come in the way of food prices. That would be the thing that would really spark potentially this period of stagflation. And we know we have big news with the meat production being really, really bad. We have countries that are hoarding some of the agricultural commodities. We have drought going on with predictions of drought here after a frost. We have also locusts, believe it or not. Lots and lots of factors that could be threatening what's already happening with the food supply on top of, you know, the supply chain. You have the labor force issues, etc. And again, if you go back to that video on 1970s, I talk about things like GDP and labor and jobs report, etc. You can have a high level of unemployment and still have stagflation. People that say, well, low demand means no stagflation, they haven't studied the history. So now, this week, agriculturals, I'm going to show you, soft commodities, I'm going to show you, started a little bit here to outperform the SPY, while GLD, which I showed to you on the daily 5, still continues to underperform. So now let's take a look. Again now, these are our proprietary indicators on the StockCharts platform, market gauge indicators, and this is going to be available to you at some point, but for right now, you're just going to have to look at my charts. And I'm just trying to find my cursor here. Come on, where are you? So this gold chart here, oh goodness gracious. One of the things there we go. I promise is that I'm going to try to find a bigger cursor for you in the future. All right, so here's the gold chart daily. I just showed you a bunch of weekly, so we're going to go to the daily charts now. So you can see that this is in a bullish phase. It's above the 50-day, it's above the 200-day. This is the 10-day, which is starting to slope a little bit negative. When I was on Monday, I showed you that momentum had hit these highs several times, and that it was starting to break down in momentum. And at that point, the price wasn't really following. But I mentioned that if we broke down under these two lows, we probably would see some type of follow through in the price. And that is exactly what we're seeing here. Also, it is underperforming the SPY right now and starting to underperform a little bit against the long bonds as well. So what does this mean? This could just be a normal correction in gold and maintains its bullish phase and starts to go up. What we're going to be looking for over the next few days is going to be what happens particularly with this momentum. Does the momentum actually continue to go down? Notice how close we're getting here to support. Boy, I really hate this stupid cursor. Sorry, here it comes. All right, here's the support. Here at these are the moving averages in our real motion indicator. And just to remind you, what real motion really measures is there any kind of divergence between momentum and price? And right now, they're pretty much in line. Momentum was actually telling us before price earlier in the week that gold could have a little bit of a correction. So now let's move on to the silver chart. Now with silver, I'm very interested in silver for two reasons. Number one is it's just so underperformed the metals, particularly the miners and the gold. And two is if there is going to be any kind of a stagflationary scenario, silver is going to have to participate in that, just like it did in the late 70s. And also in inflationary environments, what you'll tend to see is you'll tend to see silver actually outperform gold. Now, if we look at the chart, this chart, and I didn't change the colors, forgive me, but this is underneath the 50-day moving average and underneath the 200-day moving average. Here is your 10-day moving average right here. This is still in a negative phase. So basically what's happening here right now is that we've had these levels of support down here, and we may go test it again. But I still think that today in particular, what was interesting is even though it's sold off, it's still holding around that 14 level. And by the way, on the sell-off, we did get some good volume, but we did have volume coming in. Looking at the momentum indicators right now, what you can see is there's no divergence. Momentum hit resistance just like this did before it got through the 50-day moving average. That's what the red is right there on above. And now it's starting to decline in momentum just as is the price. And here down here is the performance versus the gold. And right now you can see that pretty much it's flat. So what we want to be looking for next week is for momentum to start to increase and take out this short-term moving average, this to get back over the 10 or around 14, 15, and really get a phase change, which would mean two closes above 1440. And of course, at that point, we also want to see what happens with the relative performance against gold. Now here we have GDX. Now GDX is also a very interesting chart. GDX, by the way, had this huge channel breakout. This went back for since 2017 or 16. It was about a 3 or 4 year breakout over these levels right here. And it really looked cleaner on the weekly chart, and of course that's not really great. But what we also had that is so interesting about GDX is momentum was totally going in line with price as it was making new highs. And now again, no divergence. Momentum is coming off, price is coming off. It started to underperform a little bit here on the SPY, but is coming into some support. The same thing with its underperformance a little bit of the TLTs, but also coming to support. I think that GDX and that channel that it broke out of going back from years is still very powerful, but that doesn't mean that it wouldn't necessarily break down. So really what you want to look for is for this to hold somewhere between around 3150, and then to start go back and get back over at least that 33 area. And of course, then we want to see momentum clear as well. We have a lot of room, upside room on this momentum. As long as we hold the moving averages, it's fine. But again, you definitely want to not necessarily make a move in here at this point until we see the momentum coming back. Now, I added this chart because we did a lot of talking on the 16th about the dollar. And so today I decided I would show the euro, because the euro is one of the most interesting charts right now in terms of the real motion and the actual physical chart, and then of course its price performance. So this here is the chart, and you can see this is the 200, this is the 50, this is the 10. Now today it actually held the 10, well, it actually held the 10 over the last couple of days, went right up to the 50-day moving average and stopped. What is interesting is look at the momentum. The momentum indicated right now that it's gained in momentum, and it actually cleared the moving average here, the short-term moving average. Now, the last time it did, it made this move, but again, look what happened. It didn't clear the 50-day moving average here. So what does this tell us? Very simple. If the momentum is telling us anything, and we see this get two closes above that 50-day moving average, no matter what you hear, go under the rock and just look at the euro. I think it would be a good buy opportunity at that point, and you could probably risk down to maybe under around 102.50. Looking at it to take this out comes in, I think, around 103.50, 103.60, but I like to look for two closes there, and then we can see what happens. It's already picked up against the SPY with having a little bit of a move here over the Bollinger Band, and look at that, it's starting to take out against the bonds even a little bit here over that first moving average. So euro is an exciting thing, and by the way, very good for commodities if the dollar softens against the euro. Now this chart here is the food chart, except glommed into one. This is the DBA, this is the ETF agricultural fund, so it has wheat, corn, soybeans, cows, livestock, etc. And so I've been following this. I think I've shown you this chart before because this is my whole theory right here, is that where we're going to start to see the best opportunity from the long side is going to be in the agricultural. So let's take a look and see what our indicators show us right here. All right, now what's so interesting is let's start with a look here at the momentum indicators, or the real motion. When we had the last time this went up here, real motion actually did a gain in momentum, but immediately went down below. What we're starting to see now that is really interesting is that when we made a new low in price, which we did this week, right here, you can see it, but it's a little hard to see because the volume is there, but trust me, this was a new low. At the same time, look what happened in the momentum. On this same day, momentum did not make a new low. It held. It didn't make a new low from here, and it didn't make a new low from here. So already, here's that perfect divergence that I'm talking about in the divergence between the price and the momentum. This is telling you now back here that it was bottoming out, and now that we're through the 10-day moving average, we want to see what happens here and see maybe if we can get through. I'm looking at, for the end of a week, maybe around 1370 to clear. Again, if we compare this to SPY, it hasn't cleared the Bollinger Band, but if it continues to go up, it will. And against the interest rates, again, it's getting close into the resistance here, but if it can bust through, this could finally be the opportunity that I have been waiting for. Okay, next chart. Now I'm going to show you sugar. Now the reason why I didn't show you sugar futures is because I don't want to assume that most people can trade futures. In fact, I know just from my own members, they prefer to trade the ETF. And there's some disadvantages to that, but it's better than nothing. So I'm going to show you the cane, which is the ETF for the sugar futures. Now, I will tell you that sugar futures yesterday, I did a blog on it. And in fact, you get the blog on your StockCharts platform every day under Mish's Market Minute Daily. And if you looked at it, I talked about cane, but I did it through the sugar futures. And I said that it would look like it was possibly bottoming again because it made a new low, reversed, closed on the high, had some good volumes, and cleared 10 cents. So right now, today, on Thursday, that is, it cleared 10 cents and it closed at much higher levels. Actually, considering how slow moving it's been, sugar closed at 10.42. So now let's take a look at cane. Now cane, once again, this made a new low and it made a new low in momentum. So there was no diversion whatsoever. Now the price is coming up through the Bollinger Band just as the price is coming through the 10. So it's trading in sync. There's no divergences, which is okay. It's good to look for divergences, but when there's no divergences, that also can give you a little bit more confidence in the move. It also is starting to outperform a little bit here on the Bollinger Band against the SPY and coming up right against the first moving average here relative to the interest rates. So the conclusion for this one really is very simple. If this continues to hold, and we start to see the price move up, I'd like to give this a little bit more room because this is bottomed and then faked out so many times. I can't even tell you how many times it's done. And then once in a while you get a great move like this, which we actually caught. Once it broke this line, that was it. Boom, there you go, went straight down. So I've been waiting very patiently to get back into this. But even more importantly, let's discuss why this is my secret indicator for the potential stagflation. There are really two good reasons. Number one is that sugar is very much a part of ethanol production. And of course, ethanol being tied to oil. It went down with the oil market because obviously with the glut, there was no major need for producing more ethanol. So what this could be telling us is that all of that bad news about the oil market and all about that bad news about even the production of sugar, and I've gotten so many different tweets from people, but there's too much sugar, yada, yada, yada. You know, that's all perception. That can change on a dime. If the worst is in the market, then this is where you're going to see reflected number one, is in the sugar. Number two reason is considering we just had abysmal numbers in the gross domestic product, 4.5% lower, consumer sentiment, it's like 14% lower. All these horrible numbers have come out. Remember, markets, and particularly futures markets, are forward thinking. It's possible that even though the consumer demand has reflected the start of the pandemic, which means going back into March and the beginning of April, that maybe now with the hopefulness that people are going to start to go back to work and there's going to be, you know, more medicine type of advances, etc., that the worst is in the market and sugar is going to reflect the possibility that consumer demand also has bottomed. So that means that with all of the agriculturals, the DBA kind of has the same philosophy, although with DBA and wheat and corn, etc., we have the environmental factors, as I mentioned before. We also do actually with sugar. And so I would keep my eye on the sugar chart. If I was going to look for a place to get in, it would probably be somewhere over 570. About 570, 575, because that would give me a good confirmation that this is actually bottom. And by the way, look, the volume was pretty dismal. It would also maybe give us an opportunity to see if the momentum can actually take out all of these recent highs right here and start tackling that moving average. The same thing here with the price performance on the SPY and the TLTs. If it can get through 575, I would say you have a couple of choices. Risking to the low is kind of a big risk, but this would be something buy small and kind of put away and see if it works. Or if you wanted to have a much tighter risk, really I would say probably under 525 or this swing low right here. That would be a good midpoint as well. It also matches the high from this day. Okay, so that's it. So watch the wedges and the channels and everything else that I showed you before in the Modern Family, how that behaves, either a buy or a short, depending on what happens next week. And definitely keep your eye on these commodities as well. I want to thank you so much for listening.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.